Hey guys, thanks for jumping back into the cryptoverse. Today we're going to be going over risk management with Bitcoin again, but we're going to be focusing on a more aggressive approach. So the first approach I showed in the video on risk management with Bitcoin, which I will link at the end of the video, it was a conservative approach and it works, I think, very well. But I did get a lot of requests from people wanting to, dive deeper into a more aggressive approach. If you want to be a little bit more, say, cavalier with your investment, then I would suggest watching this video. So if you guys like this content, please subscribe to the channel, turn your notifications on, and like the video. And if you want to dive in further, you can join my Telegram channel, which you can find in the link below, and check out my Patreon group, which I provide some exclusive content and ways for you to download these charts in the meantime. So let's go ahead and jump in. So in the last video on risk management and Bitcoin, we covered, the Bitcoin price on a log scale, and then this was color coded with risk. And the risk goes from 0 to 1, and 0 is dark blue, so this region, and this region, and then dark red would be a very high level of risk. So blue is low level, red is high level of risk. And I'm not going to publish this equation yet because I'm still trying to get it up on my website and everything. But just bear with me. Now, one of the things I wanted to talk about in terms of a more aggressive approach is that, one of the issues with this conservative risk approach is that this over here is dark red. This one is not quite as dark, and then over here we never even made it into this dark red zone. So I had to modify the equation some in order to account for that. And one of the ways you can think about accounting for it is if you've looked at the video that I have where we look at the return on investment from every market cycle bottom, the rate at which Bitcoin goes up is decreasing. So because of that, I had to account for that in terms of looking at risk, and we would assume that that would happen yet again in this current market cycle, which by accounting for that, it would help us elucidate more clearly where the top of the cycle is. So we're going to dive into that during this video. So let's go ahead and look at the next slide. So this is the modification to the risk formula that I've made. You can see that here we get into the red, here we get into the red, and even here we get back into the dark red. And yet we still have these bottoms over here where we get into the blue, and we know it's likely going to be a good time to invest just based on historical patterns. Now, if we take the color scheme out of it and just plot the risk on a normal on a scale, you can see that this is the old risk indicator, and the hard part in terms of having a more aggressive approach is that you can see that in the last market cycle, the risk only ever got up to around 0.71, 0.72, and so if you're really trying to time the top, if you're really trying to say time the top of the market, this specific more conservative risk indicator might not be the best approach, but if you're just looking for a conservative way to buy and sell, I still think this would work. Now, if you want to look at, say, accounting for the fact that each time the cycle repeats, we have to account for the change in the slope, then in the new equation you can see that this is what it looks like, and you can see that in this market cycle over here we hit, we went all the way up, and then over here we went all the way up. This way it could, it helps us better. It informs us more clearly where the top might be, and the reason why this is really good, this equation is really great in my opinion, is because it peaks before the peak, or right, you can see it going, it's shooting up before we get to the peak. Here, it's shooting up. You can see it's shooting up right next to this point over here. So it's shooting up before you get to the peak. So if you get, say, a notification imagine the future where I've implemented a way that you can get emails when we get into different levels. This way, when we get into this top level, it'll flash. We are in the historically highest risk level that we've ever been in, you probably should sell. I think that would be very informative for a lot of people that follow my channel. Now, how do we take this and manage our risk now? And let's look at this. So it's going to get a little complicated. I've tried to make it as simplistic as I can for just for everyone to be able to simply follow along. If you have questions, just leave them down in the comments below or join my Telegram channel, and we'll try to get those answered. So let's just go ahead and dive in. So the first thing is, because this is a more aggressive approach to risk management, this is going to keep it simple. It's going to say if the risk is 0.5 and below, you buy. If it's 0.5 and up, you sell. That's all it's going to take into account. But there's a key thing. The amount that you buy and sell below 0.5 or above 0.5 is going to be dependent on the actual risk band that you're in. Now, again, the old risk that I have that's more conservative, I still think it's a good way to go if you want to be more conservative with your investment. But if you're young, if you have money and you just want to be more aggressive because you feel like you can be, because you have more time to win it back to earn it back if things don't quite go your way, then maybe this would be a better option. So let's look to see how this would play out. So we have our buy regions and we have our sell regions. It's pretty clear. But how do you buy? How much do you buy and how much do you sell in each of these bands? So I know this looks complicated, but let's just go through it. Just please bear with me here. I think it will really be informative. You first need to decide what X is. Okay? Now, X is your baseline investment. So let's say you choose that when you're in this risk band of 0.4 to 0.5, you invest $100. Now, the point is when it goes down to, let's say you invest $100 here. Now, when it goes down a level, then you invest 2x. So then you would invest $200. If it goes down another level, you invest 3x, $300. 4x, $400, and then 5x, $500. And then on the way back up, you also invest, but you would go back to 4x, 3x, 2x, and 1x. So what does this do? It lets you get most, if it makes it down into this level, if the risk gets to this level, you're investing most of your money at this point. And you can note that this risk here, this where it gets to 5x, corresponds to the capitulation candle in 2015. Okay, you can see over here where we get to 4x, it corresponds to the capitulation candle at the end of 2019, or at the end of 2018, I should say. Here, the 5x would correspond to the capitulation candle in 2011. So it's useful because you can really get the most for your money. Now, how do you sell those? So if you're buying, I should also say, figuring out X is not easy. You have to, I think it takes some thought on your end. You have to say, okay, I'm going to put this down now, and if the risk goes down, the next month I want to be able to put in more. But if you've already maxed out, let's say you put $500 a month to crypto, and you do $500 in January, and then the risk goes down the next month. And theoretically, if this risk band is $500 and you want to do 2x, then the next month you would want to do $1,000. But if your budget is only $500 a month, and you can't do that, and then thus you can't really be a part of, say, this approach, you would just be putting in $500 every month. Now, there's nothing necessarily wrong with just dollar cost averaging the same every month. I think it works for a lot of people, and it's a simplistic way to just build up your crypto portfolio. But if you're looking to squeeze satoshis in a sense, if that's what your goal is, then maybe this is a better approach. I can't guarantee that this is a better approach because let's say we had come down here and you had invested X and you decided, okay, I'm going to make X $100 so that if it goes up later, I can do $200 next month. But let's say if we had popped right back up, then you would have only put in, say, $100 as opposed to, say, $500. So you can imagine scenarios where it wouldn't work out quite as well. But the point of my entire YouTube channel is looking at long-term momentum shifts in the market. So it's looking at these larger trends over here. That's the goal, and not getting too worked up over times when it doesn't happen like it did over here. So what does this mean? So for instance, over here, I mean, we just don't have enough data to go back, but this would have been 2x, 3x, 4x, 5x, 4, 3, 2, 1, and then buying over here, it would have been 1, and then you would have bought 2x, it would have come back up here, could have done 1x again, and then 2x again. And you know, this more or less is up to you to determine whether this would have corresponded to, say, putting 200. Maybe you want to wait until it gets to that middle line, which is fine, because there's certainly, this isn't perfect. I mean, certainly sometimes we come down below into one and then go back up into the other. But this again is looking at long-term momentum shifts. It's, you know, can we get, if we're getting in this band here and we put in, say, 100. And then at some point we realize we're in the middle of this band, then we put in 200. Then we're in the middle of this band, we put in 300, 400, and then 500. And then 400, 300, 200, 100. Okay? So this would be a way you could buy to manage your entry points and also manage the risk associated with those entry points. All right? Now, how do you sell? So the way to sell is a little bit, it's not quite as complicated. So this you would have to calculate in terms of US dollars or whatever fiat currency you're using. So you'd basically be saying, okay, I'm going to put in 100 or 200. This, once you get into the red sell region, you don't care about US dollars anymore with this method. You're then looking at how much Bitcoin do you have, okay? How much Bitcoin do you have and how much do you want to sell as we go up? So if you want to go with a more aggressive approach, so a conservative approach would be selling, say, 20% at each level. If you want to go for a more aggressive approach, you could do it like this. You would sell Y, then you would sell 2Y, 3Y, 4Y, and 5Y. Now, here it would have been 1Y, 2Y, 3Y, and 4Y if you had picked up a little bit more down here. And then here it would have been Y, 2Y, 3Y, 4Y, and 5Y. Well, what's Y? How do we figure out what Y is? Well, let's look first look at X, and then we'll look at Y to calculate exactly how you do this. So if we have X, and we say to get an idea of what you'd be putting in, if you chose X here to be a certain amount, how much would it total if we went through an entire cycle like we've done in the past? So if we had, say, X plus 2X plus 3X plus 4X plus 5X equals Z, and we step through that, you can see that we would have $100 plus 2 times 100 plus 3 times 100 plus 4, so on and so forth. And then if we continue on, we would need to multiply it by 2. Now the reason we multiply it by 2 is because this first part is just going down, and then the second would be going up. So I basically added a multiplication by 2 in here. So this would be $1,500 times 2. Okay, so if you had done that, you would have essentially had around, you would have put in $3,000. Okay, now it's going to be a little bit challenging. I mean, I'm not going to actually calculate specifically how much Bitcoin you would have accumulated because it would depend on exactly where you bought in that region. Okay, but let's just take the most conservative approach, and what that would be saying, well, once we enter the sell zone, what is the price of Bitcoin? Well, the price of Bitcoin, let's say it's roughly, let's just say it's roughly, say, $600. So if we had put in $3,000, we could say we had 5 Bitcoin. Now, theoretically, we would have had more than 5 Bitcoin because we would have been buying $500 worth down here, and we would have, because we would have been buying $500 worth at the low, you would have already picked up, say, 2.5 Bitcoin just at that point because it was around $200. So you would have to keep that in mind. And the way I tried to more or less offset this was by multiplying the whole thing by 2, just to give you a rough idea, because we're only doing 5x once, not twice. But by multiplying it twice, then I think it helps get an average, a good average price, or a good average amount for how much Bitcoin you would have accumulated by looking at the sell price over here. So it would have been probably like 5 Bitcoin plus or minus, 1 or 2 Bitcoin, just to get an idea. So then, if we're going into the sell regions with 5 Bitcoin, how would we sell it? So we have 5 Bitcoin going in. Then we'd have, say, y plus 2y plus 3y plus 4y plus 5y equals z. Okay? Now, z here is how much Bitcoin you have. So if you're going into the market, if you're going into the bull market with, say, 5 Bitcoin, if you solve this equation, then y is 1/3 Bitcoin, 0.33 Bitcoin. So that means at this level here, you'd be selling 0.33 Bitcoin. If you get up here, you'd be selling 0.66, here 0.99, here you'd be selling 4y, so you'd be selling 1.33, and then here you would be selling 1.66. So you would have been selling 1.66 Bitcoin at around 20 grand. You would have been selling, 1.33 Bitcoin at around 10 grand. So this, if you add up 1.66 plus 1.33 plus 0.99 plus 0.66 plus 0.33, you would get 5 Bitcoin. I mean, you can see pretty clearly that's 3 Bitcoin right there. That's 4, and that's 5, if we're rounding appropriately, because it's really just 1/3. It's really just 1/3 Bitcoin. So ignore this 0.167. This was a different scenario if you had 2.5 Bitcoin. But I ignored that for this video because I thought what I'm covering already is going to be kind of a lot to go over. So assuming that you are doing 0.33 Bitcoin, the nice thing about this is that you're able to sell at different regions, and you're making sure you get profit. You're not just sitting on your hands. You're not just waiting around to see what happens. You're taking profits on the way up. Why is that important? Well, here, if you had done the same thing, you would have sold, however much Bitcoin you had going into this market region over here. If you had 5 Bitcoin going in, then you would have sold 1/3 of a Bitcoin here, and then you would have sold 2/3 of a Bitcoin here. So you would have sold in total 1 Bitcoin during this region, and then now you would actually be back in the buy region. So it would have been, you would not have sold all of this, but again, it's a more aggressive approach. And if you wanted to take a more conservative approach, you would have just sold 20% here and 20% here. But by doing a more aggressive approach, you're really hoping to maximize your returns later on. So because it's more aggressive, it's not always necessarily the best solution. Sometimes being conservative can pay for itself in a sense. So it's important. It's really important to consider that when determining whether you want to go a more conservative approach, or if you want to take a more aggressive approach to managing your risk. So with that said, one of the things you might note is that we're only selling on the way up. Now, you could sell on the way down. You could have sold Y again over here. But the reason why I think it's better to just sell on the way up is because you can calculate out what, assuming we make it into this 5th level. Let's assume we're going to make it into this 5th level in the next market cycle. Then you can calculate exactly how much Bitcoin to sell at each area. If we don't make it all the way up, at least you're taking profits. And you want to make it so that when you get to the peak, you're selling the rest of your Bitcoin, basically. You want to make sure that happens, and I think this indicator will help determine where the peak is, because it seems to be preceding, the peak seems to be preceding, the peak of the risk seems to come before the peak price. It gets into this level right before the price peaks is the point. So, and another reason why it's hard to sell on the way down is because you don't really know where the way down is. I mean, you could have said this was the way down here, and then you would have sold 2Y, and then you would have sold Y, and then it would have gone back up, and then you would have had less Bitcoin. It also came down again here. But if you can say, I will sell Y when it gets to the middle of this region, I'll sell 2Y the first time it gets to the middle of this region. If it never makes it to this region, then I don't care. I'm just going to hold on to my Bitcoin. If it comes back down here, I'm going to keep accumulating. If it ever gets to 3Y, I'm going to sell 3Y. I'm going to sell 3 times a third. So I'd be selling a full Bitcoin. If it were to ever get to 4Y, I'll sell that. If it ever gets to 5, then I'll sell the rest of my stack. And I will not enter the market until we get back down into this region over here. You could take that approach. Okay? So during a full market cycle, during a full bull run, I think that would be the most productive manner, or one of the most productive manners in terms of risk, if you are going to be aggressive. But you can see here, you still would have taken profits, despite the fact that we only made it to the second region, and then now we're back in this region over here. So you could start accumulating again. You just have to figure out how much you want that to be. So, the question that I would pose to you is to think critically about this. What is your X? Okay? Because X determines everything else, right? Whatever your X is will ultimately determine what your Y will be whenever we get back into this region. If your X is $500 and we pop back up into this region, then your Y would be whatever $500 of Bitcoin would be worth, assuming you're starting fresh. I mean, I'm sure a lot of people already have, stacks of Bitcoin. But assuming you're starting fresh and you're taking this approach, then what is your X? And what can you afford to do? So this is not meant for people that just want a dollar cost average the same every month. This is meant for people who can, think about risk in terms of their portfolio and how much you might say dollar cost average this month, and then allowing yourself some flexibility to dollar cost average more in the future if it goes down, but also being okay with your current decision if the price goes up. So that's the point of the video. So what is your X? Is it $100? If it is $100, then can you afford putting $500 in if we were to go down here? If your X is, say, $1,000, then if we were to, say, go down to the 3X region, would you be able to afford $3,000 at that point? Figure out what your X is so that if we go into various regions, you could afford it with your budget for crypto. This is not financial advice, I should say. This is just a theory of managing risk in the crypto markets. That's all it is, nothing more, nothing less. So figure out what your X is, and to some degree, we are in uncharted territory, because in the past, whenever we've entered the sell regions, we've at least made it to the 4th zone. Here we've only made it to the 2nd zone. Now, if you watch a lot of my videos, I'm a big proponent of that this is going to be a 5 or 6 year market cycle, which puts us peaking potentially at the end of 2022, plus or minus a year in case it's a 4-year cycle, but even maybe going out to, say, summer of 2023 could be a possibility. And I'm not just pulling that number out of the sky. If you just extrapolate peak to peak to peak, it could be that the next one would be, say, summer of 2023. But just thinking about it in terms of our market cycle bottom to the next peak, I do think that it's going to be longer than 4 years. I don't think Bitcoin's going to be peaking at any point during 2021. At 6 figures. I think maybe in 2022, potentially 2023. Now, because of that, if that is the structure of the market for the next several years, then it's not that absurd to think that we might not have smaller runs in the meantime, where the market picks up a little bit, we see the price pump up a bit, we see it come back down. It might happen again in 2020, and then it might come back down in 2020. Because the ultimate, because Bitcoin is likely not going to peak, in my opinion, for another 3 years, then what it does in the meantime is more or less irrelevant if you're looking at, say, long-term holding for the next full bull market and we have not been in a bull market yet because we have not held any of the indicators that we normally would in a bull market. And so until we hold that, we're not in one. We just saw a pump during this year, and then during the first half of the year, and during the second half of the year, we're basically going through a correction from that pump. So it'll be interesting to see how far down we come. If you're like me, then and you believe in the long term in the future price of Bitcoin, then you want it to come down in the short term because your risk is going to get lower on your buys. Currently, your risk is sitting at this highest level here with the most aggressive approach. It's between 0.4 and 0.5. Now, because it's between 0.4 and 0.5, then historically, that is one of the riskiest times to be buying it. And which is why you should keep your buy, if you're following this method, to X. And then if the risk continues to drop, then you'll start putting more in. If we drop to 5,000, then you can put more in. If we drop to 3,000, you can put more in. So, by thinking about it like that, it can take some of the stress out of it. You don't care about the emotions. You take them out. Take the emotions out. Emotions have probably not served you well in this market. Take the emotions out, look at the numbers, and just follow the numbers. When we get to certain risk levels, stick to your strategy. You could alter this strategy too. I mean, you could make this level say X, and then you could make this level say X squared, this one X cubed. You can do whatever you want. I mean, you could, however you want to do it. The point is to decide how you're going to manage your risk during this next cycle. We have a while to figure. We most likely have a while to wait before we're going to be seeing something like this again. And the point now is to maximize your why. Okay, and one of the ways I think to maximize your why is to determine a good value for X, such that you can follow this strategy if it comes to light. That's the point. Now, I think I've rambled on for quite a long time at this point. So if you're tired of me talking, you can go ahead and tune out. But for those who just want a quick math lesson, because I thought it was interesting that 0.33 Bitcoin repeating, so it's 1/3, because just by the nature of it, this becomes 0.99 Bitcoin repeating forever, because it would be just 1/3 times 3. So the point is for my undergrad, for my graduate work I did engineering, but for undergrad I was a math major. And one of the interesting proofs that you learn is, did you know that 0.999 and then this bar here is repeating infinitely? So just imagine 0.999 repeating forever. Did you know that it is identically 1? Now you're probably thinking, oh, well, of course it rounds up to 1. I'm not saying it rounds up to 1. I'm saying it is 1. It's not, it does not round up to 1. It is identically 1. Now I've probably lost a lot of you at this point. And I just want to show you a quick way to think about it. There is actually a full calculus proof that I could go through, but I'm going to spare you on that one in this video. But here's an easy way to think about it. So 1/9 is 0.111, repeating forever. Okay. 2/9 is 0.222, repeating forever. 9/9, following the same pattern, is 0.999, repeating forever. But look, 9/9 is just a fraction, and it's 1. So this is one way you can think of it. Really when we're going back to this graph over here, I have 0.33, 0.66, and 9.99, but really what it is it's 1/3, 2/3, and 1. So just a quick lesson, in case any of you guys were interested. I'm sure I've lost most people at this point. And then finally, remember to join my Telegram channel in the link below. And then if you guys like this content and want to dive further, if you want, say, to be able to correspond one-on-one with me regularly, ask me some questions about different things, feel free to join my Patreon, which is also in the description below. There is a paywall to join the various tiers. I have 3 tiers, so check those out if that interests you. Great, and if it doesn't, that's perfectly fine. I will still be providing a ton of free stuff here, and that's completely fine. Just remember to like and subscribe, or like the video and then subscribe to the channel if you guys like this content. I hope you guys enjoyed this video. I'm sure some of you have the residual question of, well, what is the risk stuff? Well, I'm going to be trying to get that on my website soon, so once it's on there, I will let you guys know about that, and then we'll try to figure out ways for you to subscribe to notifications for, say, entering different bands of the risk levels. So, that is it for this time. Until next time, bye.